Welcome to the Money and Wealth Show, brought to you this week by AmericanManganeseInc.com. Here's your host, Sterling Fox.
Welcome to the Money and Wealth Show, the program that offers you opinions every week on business, the economy, and the markets. And this week, it's a real pleasure to welcome back to the program the Chief Investment Strategist with Institutional Advisors in Vancouver. Bob Hoye is back with us. Hello, Bob.
Good to be here.
Good to have you back with us. Always a pleasure to see you. The Canadian Finance Minister has been blowing a lot of smoke this week, a couple of days in advance of the federal budget, about his concerns about what's going on around there in the world. He talks about a fragile global economy and specifically notes the European Union, the declining ability of the United States to be our best customer, and a slowdown in Asia. Are you as concerned as the government of Canada about the fragile global economy?
Yes, it is fragile, and the reason being, Sterling, is that we've had a great bubble of speculation brew up again out of the crash that concluded in 2009. So it's been a business cycle expansion. There became a strong interest in commodities, mainly because there'd been a huge amount of stimulus, and the stimulus did not go into losers. It went into new winners. So this has reached limits, which we talked about before with our momentum peak forecaster, where it was probable that a big surge in speculation would conclude sometime around April.
I need to stop you for a second because I want to understand what you just said. You said the stimulus didn't go to losers, it went to new winners. I'd appreciate an explanation, please.
Okay, well, the problem in the U.S., where most of the stimulus was had tried to be employed.
Hundreds of billions.
Hundreds of trillions of dollars.
Right.
And it was the dreadful condition of the whole housing and mortgage market. So they figured they pushed the money into the markets and interest rates would go down, but they were low anyways. Mm-hmm. And they could somehow get the real estate market going again. But the nature of financial markets is that you're not going to get a new set of losers. Now, everybody lost in subprime, everybody lost in residential, so there's not going to be a new set of losers there to find. So it goes into the banking system, goes into Wall Street, and whatever can be played. Now, it started very nicely with agricultural products because you had a few years of very weird weather in the major growing areas. This made crop shortages. So then this then became the vehicle. And so along with base metals, because you had the story about all the buying that China was doing.
Sure, yeah.
So anyway, so then you had a new set of winners and the same old set of losers. And it's still, the latest figures I saw on U.S. house prices was, the latest quarter reporting was lower than the previous quarter. And even on a year-over-year basis, it was lower than a year ago.
And there was a stimulus element to that too, because didn't the American government offer, was it $10,000 to people buying their home for the first time? And so that money went out. Yeah. There was a little bit of an uptick in the housing market while federal money was available to be spent. But as soon as that program ended, the market went right back down again.
Yep, and that's...
So that's artificial stimulation, isn't it?
Yeah, but it went into, and any speculative move will eventually become dangerous. And it did, and as like grains peaked out in February, base metals in late March, and then you had crude oil, and the precious metals go effectively to the end of April, and then bang, it was like they pulled a pin on it. You had silver fall something like 25% in 4 trading days.
That's right, yeah.
Now, that would have been a nice trade to be short. And I know some people who were short.
I'll bet you do.
But at any rate, it is also a lesson for us. And throughout the last 400 years of history, if you have silver rising relative to gold, you're in the party mood. And then when it really soars, the party's getting out of hand. And then comes the day when suddenly silver drops relative to gold. That is, as I said, one, it's a trade. 2, it's an instruction, because when silver really falls relative to gold, it says that the speculation, whatever it was in, is over.
Well, now back to the finance minister and what he's been talking about all this past week, which is the fragile global economy. One reflection of that surely has to be the astonishing price of an ounce of gold, because people who are as concerned about the economic future are in many cases saying, I'm just going to buy me some gold and put that away and I'm good for the future.
Yeah, because we've seen, for example, various small countries, their central banks have added to their gold reserves.
Yep.
But then again, you see, you're talking about the price of gold when gold is itself an instrument that one would hold for stormy weather. But the finance minister is also, I think, trying to talk expectations down, because relative to the U.S. tragedy in the housing market, Canada's been very buoyant. And my own thoughts on this is that the buoyancy in residential real estate in Canada may not last too much longer. So he's constraining ambitions. The other thing I think he's trying to do would be to caution the whole academic community of economists who will find any reason to say, stimulus, let's do something.
And he doesn't want any more of it.
You don't want any more of it at all.
Right.
So I think they're being quite wise and cautious. And but the budget itself will not change the major tide of events, which is the post-crazy speculation that arose in 2007 and then collapsed, and then you had another wave of speculation come that is concluding more or less as we speak.
And we'll talk more about that in just a few minutes. Our special guest this week on the Money and Wealth Show is the Chief Investment Strategist for Institutional Advisors. Bob Hoye is back with us. More to come. Please stay with us.
Always consult your investment professional before making any investment decision.
American Manganese, Inc. has a manganese deposit in Arizona. Indicated 6.7 billion pounds. Inferred 8.9 billion pounds. Potentially the lowest cost producer of electrolytic manganese. American Manganese, Inc. has a projected cash cost of 44 cents a pound. The metal trades near $2 a pound. Do the math. Trading symbol AMY. Visit AmericanManganeseInc.com or phone me, Larry Ray, at 604-531-9639.
You're watching The Money and Wealth Show, archived online at TalkDigitalNetwork.com. Here's your host, Sterling Fox.
Welcome back to the Money and Wealth Show. Our guest this week is Bob Hoye, Chief Investment Strategist with Institutional Advisors based in Vancouver. Bob, you're a globe-trotting kind of guy. You have a global subscription list to your newsletter. You pay a lot of attention to the global economy. And when you were on this program with us just around Christmas, you had compiled some staggering numbers using the Momentum Peak Forecaster, and you told us all about it. And most of those predictions, if not all, have played out.
Yeah, well, thank you.
It's been quite a remarkable few months for you.
It's been a lot of fun, and we should just mention that that forecaster is a model we developed in 1998, and then we backtrack it. So back to 1970, and it has been very good when the market wants to go into a big speculative surge, and particularly when the play is in commodities. And this is what we had in 1973. It gave the signal 2.5 to 3 months before everything reached their top. And then you went into the 1973-74 bear market, which was the worst one since the 1930s. The recession was pretty bad too. Then the next big signal was right just before January 1980, which was that huge high for silver and gold speculation.
And the beginning of just stunning interest rates, as I recall, in those days.
That was part of the game, but this time interest rates are not really part of the speculation.
Not at all.
It's just dead. But what you have here is that on each of those events, 73 and in 1980, the recession started virtually as the speculation in commodities ended. Now, it's determined by the National Bureau of Economic Research, the NBER, as we all say, and they're usually about 6 months to a year behind saying when the recession started.
Okay.
But we are in the conditions that indicate that a recession starting sometime around now, using U.S. numbers, is highly probable.
I'm starting to see more and more of that, articles and bits on the internet, people basically starting to line up in rather large numbers, worrying about the onset of another recession. What would we watch for, Bob? What should we watch for in our daily lives that would give us clues that, in fact, we're heading in that direction? Not that any of us want to.
Yeah, no, we don't want it, but what comes at us,
Sure.
and that's it.
Yeah.
Well, you had a sharp or a horrendous crack in silver price. You had a large drop in most of the base metal prices. You had a pretty good setback in the grains. But the stock market did downtick a couple of steps, but it wasn't proportionate to the decline in the break in commodities. Now, most of the speculation was in commodities. But so this one is what we would say then is where the stock market went back to a downtick in April. A lot of the commodities went back to the downtick in March. So let's say if the stock market it goes down to the March lows, then takes them out, then you would have the stock market in a decline. That would confirm what's already happening in the commodities. Another thing to watch for would be the credit spreads. That's the difference between very high-grade interest rates, such as for governments, U.S. or Canadian, and lower-grade corporate bonds. So there has been a party in the spread market as well, where you've had high-yielding corporate bonds bid up in price ever since March '09 when the financial panic ended, and they're up there now. And there has been, in the last few weeks, some decline in price, and there's been some widening in the spread. Now, the widening is another warning item for us.
Bob, what about inflation? Can inflation play into a recession? Because a lot of the stuff I'm also reading is talking about, even though the governments of the United States particularly, and Canada to a lesser extent, like to pretend we don't have inflation because they don't talk about groceries and gas like everybody else does. So they are convinced, or trying to convince us, there is no inflation. We simply know better. But what relationship is there between inflation, rising inflation, and a possible recession, if any?
Yeah. Actually, for the last 5 or 6 weeks, the media have been full of horror stories about price inflation. Yes, basic consumer prices are up.
Yeah.
But at various levels within the gold and silver community, and also almost policy community, they are calling for a hyperinflation, like, for example, that destroyed the Weimar Republic in Germany in 1922-23.
Or is currently happening in Zimbabwe.
Oh yeah, I was at a meeting last month, and they had these banknotes from Zimbabwe, $1 trillion banknotes floating around. But
with which you could buy what, one loaf of bread?
Hardly. So anyways, the thing we should distinguish is the difference between Germany in 1922 and the United States now. At that time in Germany, there was no credit market to speak of.
Right.
The central bank could go to straight printing of the banknotes, and then they could start printing them in bigger denominations. Now, in the United States, you not only have a credit market, but it's the most liquid credit market in the world, the senior credit market. And what they're talking about is the credit currency expansion you get when prices of hot items are going up. And it should be understood that the stimulus isn't pushing the prices up. If the stimulus pushed prices up, house prices in the U.S. would be soaring.
Right, right.
So what you have then is that it's the rising prices in base metals, in the grains, in gold and silver. At the end of that game, everybody gets leveraged up, which then expands the money supply, expands credit. So it just can't happen in the senior economy with the senior credit market that they would turn to printing, actually printing the press, instead of coming out with $50 banknotes, they come out with $50,000 banknotes. It'll destroy the credit markets. And once you get yields at the longer maturities of U.S. Treasuries going up, somebody's going to say no to the Treasury and no to the Federal Reserve. So it's highly improbable that you're going to get a Weimar inflation in the U.S. or in Canada. It just is not going to happen.
Well, I'm going to take, I have to take a break, but I'm also going to take some relief from that prediction, Bob. And I think a lot of us are going, whew. We'll be right back with more with Bob Hoye here on the Money and Wealth Show.
The Money and Wealth Show is archived online at talkdigitalnetwork.com.
Molycorp Gold Corp has substantial assets. Magnesium deposit, inferred 52 billion pounds. Molybdenum deposit, indicated 1.9 million tons. Inferred 1.8 million tons at 0.087% MO. Past silver producer, average 182 ounces per ton. Trading symbol, MOR. Website, molycorp.com. Or phone me, Larry Ray, at 604-531-9639.
You're watching The Money and Wealth Show, archived online at talkdigitalnetwork.com. Here's your host, Sterling Fox.
Welcome back to the Money and Wealth Show. Our special guest this week is the Chief Investment Strategist with Institutional Advisors based in Vancouver. It's always a pleasure to have Bob Hoye with us. Bob, we were talking about America, the loud next-door neighbor who also happens to be our very best customer, not able to afford to buy from us at a level that we are very accustomed to. We're starting to adjust to that. We're reducing our expectations, not just from America, but that's a good place to start. How about the rest of this year, 2011? If we continue to reduce our expectations, are we going to be okay?
Yeah. Not in Canada, although it looks good now, but it's going to get, it'll fall into the decline that the U.S. will be continuing in. The reason for saying that is because, go back to what we covered, when you've had a big speculative boom, you're followed by a recession. The other one is, let's look at the timing on this, is that you had good times basically right to the end of April. And the old saying was, sell in May and go away.
I've heard that one before.
Yes.
Yeah, sure.
I didn't invent it.
I know, but it's been around a while. Not at play this summer?
No.
Okay.
So what you've got here is, just for the stock market, you get your best returns if you do all the statistics from October to May. And then the period from May to October is flat or dismal. So we have that probability. But the main thing is we had a very good party going into the end of April. So then we're looking at a further decline in the stock market to confirm that a recession is working its way into the markets. And then you can have some summer doldrums. You can have some summer rallies. That's why we always look for a typical summer, because any rally will be called a typical summer rally, and any quiet period will be called a typical summer quiet period. And then you have always the problem that the realization that there's too much high prices around in the marketplace, and then unsupportable, and then you have margin clerks coming in, and when they have more power than the central banks do from time to time. So we think the best is in for the year. We think that the stock market can extend its decline to a threatening level, and then perhaps turning around during the summer, and then there could be some awkward moments in the markets, liquidity problems later on in the year.
I get the feeling, Bob, that the summer of 2011, regardless of what adjectives they try to tack onto it, is going to be anything but typical.
Very good. Would you like to put a little wager on that one?
Oh, you think? Oh, I'm going to go up against Mr. Momentum Peak Forecaster. Perhaps I should pull in my horns a little bit.
No,
here.
I was playing on words about typical summer. Whatever happens in the summer is typical.
Sure,
but
sure.
It's not going to be pleasant.
Well, yeah, I keep hearing that. We've only got a minute here, and perhaps not an appropriate amount of time, but I'd like you to have a go at. Recently, we've seen the dollar rise and the price of gold rise together. Usually it's one or the other.
Yeah.
What happened?
Oh, when let's in U.S. dollar terms.
Yeah.
When you're in a post-bubble contraction, which is generally where we are, the investment demand for gold goes up because it's a very safe place.
Sure, you bet.
So then on days, you can have quiet days where maybe the U.S. dollar index goes up a little because there's horrible things happening in Europe. So the U.S. dollar index can go up. But if the investment demand is strong for gold, then the gold can go up in U.S. dollar terms when the dollar is strong relative to other currencies. And indeed, there's a lot of history for that, because back when sterling in London was the senior economy, every post-bubble contraction, the senior currency eventually became chronically strong relative to most commodities and relative to most currencies for most of the time. It's one of those inconveniences of a post-bubble contraction. So yes, the dollar index in the U.S. is likely to be on an upward path for some time.
Okay.
We think the Canadian dollar can come down and be around par. That would be a very, very good base for it to settle at. And investors should probably be underweighted in equities, underweighted in real estate, and underweighted in commodities, as the institutions like to say, weightings. But there's a good friendly place to be for investors. If you're too short a term, you get no interest. If you're too far out to get some yield, you're going to get hit by price. So then you want to be in maybe about 3 or 4 year Government of Canada bonds or U.S. Treasuries. And being long, say, the 3 to 4 year U.S. Treasury, you're not getting much income, but you could get some price appreciation as the U.S. dollar goes up.
We'll take that break right now on the Money and Wealth Show with Bob Hoye.
The Money and Wealth Show is archived online at talkdigitalnetwork.com.
Looking to advertise to targeted audiences? Online at talkdigitalnetwork.com or howestreet.com. On television, The Money and Wealth Show. And on radio, This Week in Money. To learn more about getting your message in front of our audiences, email us info@howestreet.com or call us 604-699-8600.
You're watching The Money and Wealth Show, archived online at talkdigitalnetwork.com. Here's your host, Sterling Fox.
Welcome back to the Money and Wealth Show with Bob Hoye. Are you optimistic or pessimistic about the balance of 2011?
Pessimistic, Sterling, because the speculation that blew out in April was so sensational that only a period of shakeout and consolidation and contraction can follow.
You've had some great advice for investors. Back off would be the summary, wouldn't it?
Indeed, yeah.
Thank you for being with us. It's great to have you back on the show.
Good to be with you.
And our thanks also to Fritz and the gang here at Churchill's at the Holiday Inn in North Vancouver for the excellent hospitality. I'm Sterling Fox, and for all of us here on the Money and Wealth Show, we'll see you again next time.
The Money and Wealth Show has been brought to you by AmericanManganeseInc.com.